Good day, ma'am. Good day, classmates. So, our topic is all about the structure of rates of return. But first, I gonna explain to you the term structure of interest rates. First, what is interest rate? So, the interest rate or required return represent the price of money. This is the compensation that a demander of funds must pay to a supplier. Interest rates act as a regulating device that controls the flow of money between suppliers and demanders of funds. When funds are lent, the cost of borrowing is the interest rate. When funds are raised by issuing stocks or bonds, the cost the company must pay is called the required return, which reflects the supplier's expected return. The central bank regularly assesses economic conditions and, when necessary, initiate actions to change interest rates to control inflation and economic growth. So now, I'm gonna talk about the term structure of interest rates and yield curve. The term structure of interest rate is the relationship between the remaining time to maturity and the yield to maturity or a band. Time to maturity is the length of the holding period of a band, while the yield to maturity is the expected return of a band. Yield curve, a graph that represents the relationship between the remaining time to maturity and the yield to maturity of a band at a given point in time. There are two types of yield curve. First type is upward sloping yield curve or normal yield curve. That is a long-term interest rate higher than short-term interest rate. Second type is downward sloping yield curve or inverted yield curve. That is a long-term interest rate lower than short-term interest rate. There are three theories used to explain the term structure of interest rate: expectation theory, market segmentation theory, and liquidity preference theory.
Theories of term structure. How does liquidity preference theory work? Liquidity preference theory suggests that investors demand progressively higher premium on medium and long-term securities as opposed to short-term securities. According to the theory, which was developed by John Maynard Keynes in support of his idea that the demand for liquidity holds speculative power, liquid investments are easier to cash in for full value. Cash is commonly accepted as the most liquid asset. According to the liquid preference theory, interest rates on short-term securities are lower because investors are not sacrificing liquidity for greater time frames than medium or long-term securities. What is the market segmentation theory? Market segmentation theory is a theory that long and short-term interest rates are not related to each other. It also states that the prevailing interest rates for short, intermediate, and long-term bands should be viewed separately like items in different market for debt securities. What is expectation theory? Expectation theory attempts to predict that the short-term interest rates will be in the future based on current long-term interest rates. The theory suggests that an investor earns the same interest by investing in two consecutive one-year bond investment versus investing in one 2-year bond today. The theory is also known as the unbiased expectations theory. What is liquidity preference theory? Liquidity preference theory is a model that suggests that an investor should demand a higher interest rate or premium on securities with long-term maturities that carry greater risk because, all other factors being equal, investors prefer cash or other highly liquid holdings.
Risk interest rate structure. There are three specific risk factors. First is default risk, second, liquidity, and the third is income tax consideration. Default risk factors. One contribute of a bond that influences its interest rate is its risk of default, which occurs when the issuer of the bond is unable or unwilling to make interest payments when promised. Unable or unwilling, which means that are not ready to the payments that they promise. There is failure on fulfilling the obligations in the payments. Next, U.S. Treasury bonds have usually been considered to have no default risk because of the federal government can always increase taxes to pay off its obligation. Bonds like this with no default risk are called default-free bonds. Default-free bonds is the books with no default risk, such as U.S. government bonds. The example of the no default risk is the U.S. government bonds. The spread between the interest rates on bonds with default risk and default-free bonds called the risk premium. Risk premium is that only required by individuals to give increased level of risk. Indicates how much additional interest people must earn in order to be willing to hold the risky bond. A bond with default risk will always have a positive risk premium. An increase in its default risk will raise the risk premium. Just another information ahead is bonds, which is a debt or a premise of the investor interest payments. The bond is most issued by the corporation and the government. Now, if the corporation begins to suffer large losses, the default risk on corporate bonds will increase. The asset would become riskier. When a corporation suffers losses, the asset would become riskier. It includes here the equities, commodities, high-yield bonds, real estate, and currencies. The demand for riskier bond will decrease. The demand curve for the corporate bond would shift to the left. The bond price will fall and interest rate will rise. On the other hand, the treasury bonds are now less risky relative to the corporate bond. Therefore, demand for this bond will increase as reflected in an rightward shift in the demand curve. The price of this bond will increase and the interest will fall. Therefore, there will be a positive risk premium. A bond with default risk will always have a positive risk premium, and the risk premium increases with increase in default risk. Liquidity. Treasury bonds are the most liquid of all long-term bonds because it is easiest to sell them at a low cost. It is important that to meet needs at the lowest cost because here is the opportunity of the people to experience the products. People have to choose whether they buy the lowest cost or the high price. The lower liquidity of corporate bonds relative to the treasury bonds increases the spread between the interest rates on these two bonds because with increased relative liquidity, the demand for treasury bond will increase, pushing its price up and interest rate down. On the other hand, when relative liquidity of the corporate bond is less or lowered, its demand decreases, resulting in a decrease in price and hence increase in interest rate. Therefore, the risk premium of the corporate bond becomes positive. Liquidity risk refers to how a bank's inability to meet its obligation threatens its financial position or existence. Institutions manage the liquidity risk through effective asset liability management. Liquidity risk occurs when an individual investor, business, or financial institution cannot meet its short-term debt obligations. The investors or entity might be unable to convert an asset into cash without giving up capital and income due to the lack of buyers or an inefficient market. Tax consideration. Tax consideration means the consideration deliverable hereunder to the unit holders that is treated as purchase price for U.S. federal income tax purposes, including to the extent properly taken into account under applicable law, the assumption of liabilities. If payments on certain bonds are exempted from income taxes, then the expected returns from those bonds increase. This leads to an increase in the bond for those bonds, which pushes up bonds prices. Consequently, the interest rate lowers. Therefore, these bonds tend to have a negative risk premium compared to the other corporate bonds. In India, there are many tax-free bonds or securities. Most often public sector companies like Airport Authority of India. Tax advantages of municipal bonds. Interest rates on municipal bonds and treasury bonds. When the municipal bond is given tax-free status, demand for the municipal bond shifts rightward and then demand for the treasury bond shifts leftward. The equilibrium price of the treasury bonds falls and interest rate rises. The result is the municipal bonds end up with lower interest rate than those on treasury bonds. Thank you.